You know that feeling, right? You're faced with two great choices, but you can only pick one. Well, in the world of investing, a decision like that can mean the difference between making money and losing it. So, how do you decide when both options seem pretty good? It's definitely not about just going with your gut. It's about having a system. Today, we're going to put two projects head-to-head in a real investment showdown and see how a clear set of rules can find us a decisive winner.
Okay, so picture this. You're in the driver's seat, you've got cash on hand, and you're ready to put it to work. In front of you are two opportunities, Project A and Project B. They're both competing for your capital. Your job, figure out which one is the smarter bet. So let's meet our contenders. All right, let's break it down. Project A, it needs a $3,000 investment. In return, you get $1,000 in year 1, another $1,000 in year 2, and a nice $2,500 in year 3. Now, Project B needs a little more up front, $4,000, but it promises some bigger payouts in those first couple of years. So, which one is really the better deal? Just looking at it, it's a tough call, isn't it?
And this, right here, is the classic investment dilemma. You can't just flip a coin or go with what feels right. To make a smart, informed decision, we need a framework. We need some financial tools that can cut through all the noise and tell us, objectively, which project is going to create more value.
Okay, before we analyze a single thing, we have to get on the same page about one absolutely fundamental idea, the discount rate. The easiest way to think about it is like financial gravity. A dollar in your hand today is worth more than the promise of a dollar a year from now, right? Because of risk, because of inflation, because of other opportunities. For our showdown, we're setting that discount rate, our minimum acceptable return, at 15%. This is the hurdle that both of these projects have to clear.
All right, let's kick off round one of our competition with the heavyweight champion of investment metrics, net present value. We just call it NPV. This test is going to tell us the total value that a project creates, all measured in today's dollars.
Now, what's so cool here is you can actually see that financial gravity at work. We take those future cash flows from each project, and we use our 15% discount rate to pull them all the way back to what they're worth today. I mean, look at Project A's big $2,500 payout in year 3. In today's money, it's only worth about $1,643. We are translating future promises into cold, hard, present-day cash.
And after we add up all those discounted values and subtract the initial cost, Project A comes out with a net present value of a positive $269.50. Now, the rule here is incredibly simple. If the NPV is greater than 0, you accept. This project doesn't just clear our 15% hurdle, it actually creates extra value on top. That's a great sign.
But then we turn to Project B. We run the exact same math and, oh boy, it ends up with a negative NPV of $19.56. That is a major red flag. It's telling us that Project B doesn't even meet our minimum 15% required return. In fact, it actually destroys a little bit of value. So based on this test alone, Project B is already in big trouble.
So Project A smoked the first round. But you know, it's always good to get a second opinion. So let's check our work with another powerful metric, the internal rate of return, or IRR. Think of this one like a race to see which project's money is working harder, generating a higher percentage return all on its own.
And this chart just tells the whole story, doesn't it? The IRR is basically the rate of return that a project earns internally. For Project A, that IRR is a very healthy 19.54%. That's way above our 15% hurdle rate. But Project B, it clocks in at just 14.72%. It's close, but in investing, close isn't good enough. It fails to clear the bar.
And the rule of thumb here is just as straightforward as with NPV. If a project's internal rate of return is greater than your minimum required return, you accept. So once again, that's a clear yes for Project A and a definite no for Project B.
Okay, at this point, the winner seems pretty obvious, right? But hey, in investing, you always check the fine print. We're going to run two more quick checks, the profitability index and the payback period, just to make absolutely sure our conclusion is rock solid.
The profitability index is such a great little tool. It asks a really simple question. For every single dollar I invest, how much value do I get back in today's dollars? For Project A, the index is 1.09. That means for every dollar you put in, you get $1.09 back in value. Awesome. But for Project B, it's 0.995. You're actually getting a tiny bit less than your dollar back. The rule? The index has to be greater than 1. So once again, Project A takes the win.
Our last check is the simplest one of all, the payback period. This isn't about creating the most value,
It's all about speed. It answers that question that every single investor asks: how quickly do I get my money back?
So let's track this payback journey for Project A, using those discounted cash flows we calculated earlier. We start $3,000 in the hole. After year one's return, we're still down over $2,000. After year two, we've clawed back some more, but we're still in the red by about $1,300. It's sometime during that big third year that we finally cross the finish line and break even.
And when you do the precise math, you find out that Project A pays back that initial investment in 2.84 years. That gives us a really clear timeline for when our capital is no longer at risk. As for Project B, well, since it never actually generates a positive value for us, it technically never pays back in economic terms, so we don't even need to calculate it.
So, we've put the numbers through 4 different rigorous tests. We've looked at this from every angle: total value, rate of return, efficiency, and speed. I think it's about time we gather up all the evidence and declare the official winner of our investment showdown.
And there it is, the final scorecard. Folks, this is what you call a clean sweep. On net present value, Project A is positive, B is negative. Winner, A. On IRR, A sails over the hurdle, B trips right before the finish line. Winner, A. Profitability index, A is over that crucial 1 mark, and it has a clear payback period. In every single category we looked at, Project A is without a doubt the superior investment.
So what's the most crucial point here? It's that what might have looked like a tough call at the beginning became an absolute no-brainer once we applied a consistent, logical framework. Gut feelings are tricky and they can be misleading, but a disciplined, data-driven approach, that gives you clarity. In this showdown, Project A isn't just a little bit better, it's the only acceptable choice. The rules simply don't lie.